US government shutdown. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic.
Every crypto cycle gives us a surprise, but this one has delivered a shock even Raoul Pal didn't anticipate. For years, we've all planned for the post-halving acceleration, the banana zone, the liquidity wave, the structural drivers that should have kicked prices into high gear by now. And yet here we are. Bitcoin is grinding sideways, liquidity isn't breaking higher, and the most important macro catalyst of the year came from the one thing almost nobody priced in. According to Raoul, everything we expected did happen, except for the part that didn't. The US government shutdown, the freeze in spending, and a sudden $700 billion tightening in financial conditions have quietly dragged the cycle off its usual rhythm. It's the one curveball even the best macro analysts didn't see coming, and it's fundamentally reshaping this bull market. But here's the twist. Raoul's view isn't that the cycle has failed. It's that it's been delayed and stretched. What he's seeing now points to a far larger, more powerful move ahead. His entire everything code thesis is built around demographics, debt, and liquidity, long-term structural forces that don't disappear simply because sentiment is tired. And based on those forces, he still expects the real peak of this cycle in 2026, not 2025. Not the typical one-year post-halving top we've been conditioned to believe in, but a 2-year runway fueled by a massive liquidity expansion he says is mathematically unavoidable. If you've been feeling frustrated, or wondering why Bitcoin hasn't reacted to the liquidity we thought was coming, Raoul's explanation will make the entire picture click. Now, I know what some of you are thinking. If liquidity is the whole game, why is nothing moving? Why do these models look broken? Honestly, Raoul's answer surprised me too. We were all watching ETFs, watching institutional flows, waiting for the Treasury to release liquidity back into the system. And instead, the government shut down. The TGA got stuck at $1 trillion, the drain never happened, and the single strongest driver of risk assets went flat. You're probably looking at your portfolio right now thinking, this can't be the same bull market Raoul has been talking about. But in his view, it absolutely is. It's just operating on a timeline that none of us, including him, had fully accounted for. And once you hear his breakdown, you'll see why he's still as confident and bullish as ever. So in today's video, we're going straight into Raoul Pal's updated analysis. Why the cycle has stretched, what really derailed the liquidity wave, and why he still believes the most explosive part of the bull run is ahead of us, not behind us. If you appreciate clear, grounded macro explanations that actually make sense of this frustrating market, make sure to like this video, subscribe, and hit the bell so you don't miss the next update. All right, let's jump into it.
Let's start with the big picture. What are we doing here? Why does Raoul have this everything code thesis? What has he built? I try and explain to people, and I've done videos on this. This is how the world works. It's simply the structure of which the entire system functions and why it functions that way. So it's all about demographics. After World War II, I'm not going to talk for hours about this stuff. The Treaty of Versailles, after World War I, basically forced the Germans to pay reparations to the French. That caused the Germans to essentially go bankrupt and have to hyperinflate. That broke German society and caused the rising of the Nazis. That led to World War II. World War II, the end of it, led to a baby boom from world peace. Baby boom was the largest demographic boom of all time. That baby boom has basically driven the global economy ever since. The inflation of the 70s was not a monetary phenomena. It was actually driven by demographics. It was driven by the baby boom cohort coming into the workforce all at the same time, demanding goods. And there wasn't enough supply for those goods, so the world had to adapt. Then we had obviously the Suez Crisis and a bunch of other things that came onto it, and a bunch of money printing and other stuff that happened. But and then leaving of the gold standard, all of this stuff. But really, it's a demographics issue. As they've aged out, they've also driven everything from investment markets, index funds, pension market. Everything has been driven by this cohort. So this cohort is now retiring. It's leaving the labor force. As it leaves the labor force, we can project out into the future because of the births, deaths. What happens to the labor force participation rate? This is happening everywhere. It's falling over time. So as it falls over time, and forecastably so, we increase the debt to goose growth, because growth is driven by population growth, productivity growth, and debt growth. Debt growth is this part that I'm showing you, is to offset the slowing of the population growth and that decrease in the labor force participation rate. Less people being productive in the labor force, old people are less productive, and that leads to slower growth. So the government increases debt to offset it. That debt is financed by liquidity. This measure here is the Fed net liquidity, but actually in recent years, it's moved to US total liquidity and global liquidity for the global debt cycle. What's the difference between Fed net liquidity, global liquidity? Fed net liquidity is the Federal Reserve balance sheet plus the Treasury General account and the reverse repo that's now been drained and probably will never get rebuilt. But they've moved the liquidity onto the banks now, which is what our total liquidity measure takes into account, that plus M2 growth as well. Anyway, it doesn't really matter. Liquidity is the baseline of money to pay the debt, driven by the demographics. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it. Then we've created this cyclicality. We had a perfect 4-year ISM cycle that changed. And it's driven, the cyclicality of the economy is driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect. And that was because the debt maturity of the debts after 2008 was 4 years. And then something changed. And we're like, what's going on here? We didn't really understand it until we went back to this and redid the maths and realized in 2022 and 21, when rates went back to zero, they extended the maturity of the debt from 4 years to 5 years, or 5 and a bit years. And so what that did was break this. We had this extra year in the middle that we never had before. The extra year in the middle didn't need peak refinancing. The refinancing is for this coming 12 months. So we haven't had peak refinancing. So you didn't get peak economic growth. Economic growth was held because we didn't get that stimulus. Rates remained higher because of it. And the cycle extended to this. And this is the 5.4-year sine wave. Now, we don't know what the next cycle is going to be, depending where all the debt maturity ends up. They're all sticking it in the short end right now. It might shorten it back down to 4 years. Don't know. We'll have to see. But this is what we're dealing with. And where we should end up is peak cycle is somewhere towards the end of 2026. This is the reason we don't believe in the 4-year Bitcoin cycle that's suddenly independent of the NASDAQ. They're all the same cycle. Or the ISM, it's all the same cycle. But suddenly some people online are like, well, it's all over now. We didn't get our rally in November and October. It's finished, all over. Let's come back again in 18 months' time. Probabilistically speaking, that's a load of wank. That probably gets me banned from YouTube. But wank's a great expression in England. Okay, so the game is paying the interest payments of the debt. That is where the debt growth is coming from, is the interest payments. Don't forget, the interest payments are now a larger part of the US budget deficit than the military is. And we do that by printing money. Dun, 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 dun. I mean, Christ, I've told you this a million times. So we print money, and look, we've got lots of debt to roll, and we need to print money to do it. Okay. And hey presto, gold has been following this like it knows. Yeah, because gold is real-time financial conditions right now. Financial conditions, the dollar, interest rates, and commodity prices. And gold is reflecting financial conditions, which is the forward look on liquidity. I'll come on to that in a sec. A bit confusing for you all, but gold is kind of explicable right now. Here's GMI global total liquidity versus gold. Gold says it should accelerate. Global total liquidity has been it got to new highs. It's flatlined a little bit because of what the US is doing. Meanwhile, China's increasing the use of its balance sheet, and the dollar's gone up a little bit. I think it probably rolls over at some point soon. We'll come on to that in a sec. And that then may lead to the final leg higher in gold and the final leg higher in markets. But you can see gold is basically pricing global liquidity impulse all the way to the end of 2026, which would be kind of what we're expecting for the cycle. Again, don't expect perfection. Raoul said, everything moves, deviates. You need to assess the probabilities, see the data as it comes in and understand. But when I put gold versus I don't know why Julian's put everything in pink. I don't know. He's feeling flamboyant. But what we've got is that's interest payments. Gold is forward pricing it. And following up is liquidity, which lags gold by 12 months. So we've actually got the phasing of all of this, these dominoes. We talk about these dominoes all the time. And why it matters to us is because it explains 90% of crypto's moves over time. Now, again, this is the issue with the impatience and the people who don't understand this stuff is like, well, liquidity's moved. Why hasn't Bitcoin moved? It's all broken. Everything's shit. It's like, no, it doesn't work like that. There is a variability around this stuff. This is a weekly plot chart going back 11 years. Not 11 years. It actually goes back, 12 years now. And you get variability around the mean. That's how markets work. That's the 10% difference in correlation. So you expect differences, and the differences give you informational value. But what you get is this stunningly high correlation over time. And again, people don't really understand this. They're like, your charts are just correlation versus causation. They're bullshit. You're just inventing stuff. I'm like, no, and no.
What Raoul lays out in that first segment is the foundation for everything that follows, the real machinery behind the crypto cycle. And honestly, this is where most viewers and analysts start to lose the plot. We love simple explanations. ETF inflows, halving supply shock, Fed pivot, things like that. But Pal keeps reminding us that the deeper driver is structural: demographics, debt, liquidity, and the rolling nature of refinancing. And here's the uncomfortable truth he's pointing toward. If you don't understand that underlying engine, the market feels random. You look at Bitcoin chopping sideways and think, but liquidity already turned positive. Rates are falling. Why isn't this thing going up? Raoul's answer is brutally simple, because the cycle changed. 2024 is the missing middle year, a year that never existed in previous cycles, because debt maturities were always clustered every 4 years. When rates fell to zero again in 2020 to 2021, corporations extended their debt out by an extra year. That one change distorted the entire cycle. Suddenly the stimulus, the liquidity impulse, the reflation wave, all of it shifts forward. The frustration everyone feels, the impatience, the disbelief, that's exactly the point. The cycle isn't broken, it's just longer. And that's why Raoul keeps insisting that the peak of this cycle is not 2025, not this halving year, but late 2026. It sounds crazy until you realize the math aligns perfectly. Liquidity, interest payments, debt rollover, demographics, and even gold. They're all pointing to the same apex. Which brings us to the part almost nobody saw coming, the blind spot that threw the entire liquidity model off balance.
Okay, US government shutdown. This is where we got it wrong, because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic, and there's no offset. See, in 2023, when it happened, they were draining the reverse repo, and it offset it. But this one didn't have that. And so we didn't really see that. And that was what caused that global M2 chart that, like, people just don't understand, because I said it's not going to work all the time, but why didn't it start? Why did it break apart? Well, it broke apart very simply because liquidity got sucked out of the system, and it got sucked out of the most beta to liquidity asset in the world is crypto. So it came out of crypto. And if you think of the crypto beta curve, you got Bitcoin and then Solana, let's say, and then let's say SUI. They're all different levels of beta or leverage to this trade. And what happened is liquidity starts coming out over this period. Now, the TGA should have been started draining two months ago. And once they drain it, it starts lifting asset prices significantly, the normal cycle. What happened this time is the shutdown of the government. So they couldn't drain it. So it got stuck at $1 trillion. And normally you drain it, but they didn't. So normally we would have seen something like 2022 where we start to see a drain. We didn't get that because it got stuck because they stopped spending money. So therefore, no liquidity in the system. Therefore, stuff like M2 doesn't flow through the system and things fall apart. Now, NASDAQ didn't because 80% of all asset managers had underperformed the benchmarks this year because none of them had technology, and they still don't. There's still a record number who think AI is a bubble and therefore they're underexposed. So the more tech goes up, the more they have to buy into year end. And that dynamic's always very interesting. It's called performance or benchmark chasing. Added to the fact there's a load of buybacks in that sector as well. Very hard to fade. Very hard to fade unless liquidity is fully, totally turned and rates are going up and all that kind of stuff, which is not happening. The other thing is, if we think about the crypto market outside of Bitcoin, you'll notice that none of these things have gone to new highs, really. I mean, Ethereum, Solana, none of this has. Why? Because it's driven by liquidity. US total liquidity has not gone to new highs yet, but it will over time because, again, to keep explaining this to you guys, because you don't want to hear me, and you lose patience, then you go, why didn't it go up? Is we've got to do this game. We've got to pay for the interest on the debt. The only way of doing it is global liquidity, or is total liquidity. And as you go through, that then lifts that. So if you go back to that chart, there's the hockey stick over time, that longer term version of the banana zone that has to come into play, because if not, the whole system falls apart. So there you go. Now, the last time it shut down was back in 2019. Again, we kind of broke the plumbing of the financial system back then. We broke the plumbing back then. Once it reopened, so it shut down, the markets didn't like it for the same reasons. The plumbing started creaking. The Fed had to come in, start going back from QT to QE, and also injected liquidity. So here we are. The shutdown's ended. It takes a while before the money starts flowing. So the TGA's only just kind of released $40 billion, but we're expecting like $200 billion or $250 billion over the next 2 months. So what happens then is eerily similar, should stabilize coming few days, next week, today, who the hell knows, doesn't really matter. I know it feels like it does, but it doesn't. And then the market took off like a rocket ship. And all of this is to say that the reason we look at all of this stuff is Bitcoin is, and crypto is, a macro asset class. That's the important thing to understand. What it means by macro, it's driven by macroeconomics. And macroeconomics, for me, is the business cycle. And here is the business cycle, up and down. We talked about that before. And lo and behold, remember that, the 4-year cycle? Well, that was the crypto cycle. No shit, Sherlock, because it was the debt refinancing cycle. And right now, the ISM is kind of in that middle year where it's not hooked up, not grown. Bitcoin's slope has been frustrating for people. I want this bit. Well, it's going to come in the next 12 months, and everyone's going to go, he said that last year. He's a moron. He's just a snake oil salesman. Look, market analysis is not some sort of crystal ball where you see the absolute truth in everything. The everything code is the truth. How it plays out is still something we need to learn. And we need to understand the nuances. When the world gives you lemons like a government shutdown, you need to deal with it. You bought the ticket, you take the ride, and you just kind of grow up and deal with changing probabilities, because that's how the world works. When we look at financial conditions, this is our financial conditions index, which is correlated to gold, as I said, even though gold's not in the index. Total liquidity lags it, so by 3 months. So it's suggesting that liquidity should start rising. which makes sense because we know what we've got to do. We've got to pay the debt, and we know that the TGA is going to be drained, and the QT is going to finish, and the Chinese are increasing their balance sheet, and we got regulatory changes coming, and we got rate cuts coming, blah, 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 blah. And the ISM, the business cycle, follows that. So the next thing for the business cycle is to go higher. Business cycle going higher means we'll have money in our pockets. It goes into risk assets, and that increases the price of crypto.
Raoul Pal isn't walking back his entire thesis. He's sharpening it. What he's saying now is that this bull market didn't disappear. It shifted. The sudden collapse in government spending, the stalled TGA drain during the shutdown, and the liquidity freeze caught the entire system off guard. It didn't break the cycle. It pushed it forward. And once that liquidity engine restarts, the pressure that's been building under the surface doesn't unwind quietly. It erupts. That's why Raoul keeps pointing to 2026 as the real peak of this cycle. Not because it sounds provocative, but because the liquidity math demands it. And if you zoom out for a moment, his argument is much bigger than a price call. It's a reminder that macro cycles don't care about impatience. Debt has to roll, liquidity has to expand, capital has to move somewhere. And historically, when those doors open, Bitcoin is the first asset to sprint through. What we've experienced isn't a failed cycle. It's a delayed ignition. The kind that looks flat, frustrating, and hopeless right before it accelerates. But before anyone celebrates the next leg higher, there's something every investor needs to hear. Something widely followed crypto investor Punk6529 put into words beautifully in a recent post on X. Is it over? Was it all a fever dream? Have we run out of steam? This is the worst crypto Twitter timeline I have ever seen. No narrative, no spark, nothing. He's right. This doesn't feel like capitulation. It feels like boredom. The kind of boredom that shows up after people chase every shiny object except the thing that actually matters. And his warning is blunt. The industry has drifted away from its core, not toward innovation, not toward decentralization, but toward the comfort of institutional approval. Team Bitcoin is 100% about driving price action. More and more Bitcoin ends up in Coinbase custody. None of that Bitcoin is nation-state resistant. This is the part no one wants to confront. The ETF era is convenient, but not neutral. The narrative has become FOMO, driven instead of freedom-driven. And Punk6529 forces every serious investor to ask the uncomfortable question: are we building the future, or just building a shinier version of the existing system? Scenario A, BlackRock owning all 21 million Bitcoin, is a failure. A polite, well-regulated failure. Scenario B, billions of people holding their own keys, is the entire point. And the timing of this conversation couldn't be more critical. Just this week, news broke that regulators are exploring deeper custodial oversight over digital asset service providers. A sign the window for genuine permissionlessness is narrowing, not widening. Investors need to decide, right now, which side of Bitcoin's future they're actually supporting. Because here's the truth: price targets matter, liquidity cycles matter, macro matters. But none of it matters if the underlying asset loses the properties that made it transformational in the first place. This is the moment to zoom out, not just on the chart, but on your principles. What do you really want Bitcoin to become? A macro trade? Or a decentralized asset that no government can seize or stop? That's the question Punk6529 is pushing into the center of the conversation. And it's one every serious investor should be wrestling with before the next phase of the cycle hits. And leave a comment. Tell me what you think. Has Bitcoin drifted too far from decentralization? Or is this just another phase before the market resets its priorities? If this breakdown helped you see the bigger picture, both Raoul Pal's macro roadmap and Punk6529's challenge to the entire ecosystem, make sure you like the video, subscribe. Thanks for watching.